Welcome to the Motley Fool's Crunchtime series, where we scout out a single company from the story to the opportunities and risks. Let's take a look at the biggest brand in monthly dividend stocks, Realty Income. First, my prediction. I don't think Realty Income will outperform the market over the next 5 years, but that doesn't mean it's not the right investment for a lot of people, including me. Now, let's dig in. Realty Income's business strategy boils down to a couple things. Realty Income owns standalone commercial real estate and it leases it to business operators that rely on those properties to generate revenue. Its customers include some of the biggest big box retail giants, supermarkets, restaurant chains, convenience stores, casinos, resorts, fitness centers, and even more. If you're a big company that relies on standalone real estate, you have Realty Income on your speed dial. The company's strategy is to be the partner of choice for those companies that need lots of standalone real estate, but don't want to own all of it. Whether it's acquiring and leasing back properties from a tenant to help it free up liquidity and move assets off its own balance sheet, or helping identify and procure future properties for expansion, or consolidate the properties of an acquisition, Realty Income creates a lot of value for its tenants. Now, its strategy also includes industry consolidation. Despite being the giant in its industry, Realty Income only owns a small fraction of the addressable properties. Leveraging its skill as an acquirer is key to its ability to increase its cash flows over time. Now, this isn't a growth industry, and its tenants often face a lot of competition, cyclical pressures that impact their growth, even cause them to shrink. This means Realty Income's growth opportunity is largely growing rents over time and also consolidating those properties that it doesn't own. Despite its record of growth over the past 3 decades, this means investors should really have modest expectations going forward and own it based on the above average dividend yield and its ability to modestly grow that payout over time. Now, Realty Income takes on the risks its customers want to avoid largely. First, finance costs and interest rates. Interest rates, of course, have moved a lot higher. That means it's increasingly going to take more of its cash flows to cover, taking money away from dividend growth. Next, tenant execution risk is a risk that it faces. If its tenants struggle or have to close a location, Realty Income still has to pay for that property and it has to find a new tenant, and it may have properties sitting empty, generating no income from time to time. Now, an example is it currently faces some risks from its pharmacy tenants where that industry is starting to shrink. Now, let's talk my prediction. I own Realty Income. I have no plans at all to sell, but I don't expect it to be a market-beating investment over the next 5 or even 10 years. But I do think it will be very reliable. And in addition to the 5.5% yield at recent prices and that modest dividend growth, the growth of its property base should probably result in a few percentage points of stock price growth most years too. Now, that might not be the double-digit gains many investors want, but this is a great investment to supplement your portfolio with long-term income and a little bit of wealth generation too. Now, let's wrap things up. Here at the Motley Fool, your comments make us smarter. Please comment with your own research and insights about Realty Income. Tell us what stock you want to see us tackle next. Plus, if you go to fool.com/invest, you can receive the top 10 best stocks to buy right now.